Hi everyone, this is a screencast for Independent Colleges Dublin for P6 Advanced Taxation, covering the area of purchase of own shares. Now I'll draw your attention to question 5 basket in your BPP exam kit. I believe that's on page 284 of your kit. So do have a look at the question before you view this screencast, because it focuses to a large extent on the answer rather than the question. So a typical scenario that this area comes up as is really a situation where there is some sort of dispute or disagreement within a company in relation to, or indeed between, a set of shareholders, and the company has decided as a result of that to simply buy back the shares that the individual shareholders hold. Okay. Now it may well be that you think that the easier way to look at this is not so much a purchase of own shares, but a sale of own shares, because in essence all that we have here is a shareholder who happens to have an asset, in this case a share, who's selling it. And the key issue really is, what is the treatment for the individual, indeed, for tax purposes? We have two main treatments. We've got the distribution or dividend treatment, and we've got the capital gains tax treatment. And really the latter is seen to be more advantageous, really because of cost. Historically, CGT rates will have been lower, so more often than not, people will decide that adhering to the conditions for the capital gains tax treatment is going to mean a lot more cash in their pocket. Okay, but as is the case always with the revenue, when you're getting a tax break from them, you have to satisfy a series of conditions, and we'll touch on those in a moment. So really what you'll see from the scenario here really is that there's some sort of dispute, and the company are looking to sort of close it off and really, I guess, get rid of the shareholders. So the key issue is, what are the conditions for the capital treatment, and what's the impact upon the company? Okay. So in terms of the requirements for this particular question, what you'll see from the page, if I scroll down here, is that we simply have a couple of shareholders, and we're looking to apply the relevant tax legislation to their situation. First requirement is just to set out the conditions, and that's very much rote learning. I would say you're probably getting around about a half mark or thereabouts for each condition. Second area, part B here, is really setting out the tax comps, as it were, based on each of the individuals, Paul and Ronald. And you'll see more often than not in these types of questions where there's two possible routes to go, is that one will probably satisfy the conditions for the CGT treatment and one won't. Okay, and notice that the number of marks here, quite a lot of marks here for really what are fairly straightforward tax computations. One an IT comp, as it were, and the other a CGT comp. Okay, and then just an add-in down here at the bottom in terms of any other issues, and I'll take you through them in a moment. Okay, so if we look at the annotated PDF on this in terms of the answer, and you'll get that obviously from your BPP kit. First part here is conditions for the treatment, and I've listed down the left-hand side the ones that you really need to remember. First one is that the shares need to be held for 5 years. Obviously, it needs to be for the benefit of the trade, and the revenue would take that as being really a situation where if there's a dispute or disagreement, it's certainly for the benefit of the trade for the shares to be bought back. Resident and ordinarily resident. Last one there is something that students find it difficult to sort of understand. It's just this idea of a substantial reduction. In other words, if we look at the shareholding before and after, we have to have a 75% reduction in the shareholders' shareholding in effect. Okay, and the last one is really what they call the connection test. In other words, after the purchase, the individual cannot be connected, and that would be a holding of an excess of 30%. Okay, so what you'll see is the conditions just laid out here, a little bit more than 5, but I think 5 would do us if we can just remember the key elements of those as shown on the left-hand side. Okay, if we move down, what you'll see is that the balance of the question, indeed the tax computations, etc., just look at whether or not the individuals concerned comply with these rules above. Okay, so that's often the way that he looks at things. He'll ask you for some stuff that hopefully you will have rote learned, and then he'll ask you to apply the information to the scenario of the question. So if we look at the second point, we're talking about two individuals, part B here. What he clearly wants you to do is to identify whether or not the conditions are satisfied and how they are. So, watch for this area here. He definitely qualifies. He's held the shares for more than 5 years. It would be for the benefit of the trade, although that's not specific to him, and that he will be resident. So, watch out for him bringing in other areas like this in a question. So it looks as if he will be resident. And indeed, in relation to the last point here, the buyback comprises 100%. So obviously, those tests will be satisfied, the 75% substantial reduction and also the 30% connection test. Okay. In terms of the computation, this is important here. So I'm going to draw your attention to this little comp. As you can see, it's a fairly straightforward three-liner, what we call a three-liner: proceeds less cost equals gain. But this particular area is important. Now, in terms of the proceeds are going to be the same between the two treatments. Okay, this is what's different. So aside from the more attractive rates for CGT purposes, the idea that what you deduct from the proceeds is the cost of shares and not the par value is important. So do remember that. We're looking at the cost paid for the shares and not the par value. Obviously, the AE is deducted and then 33% applied for CGT. Okay. In terms of the assumptions there, pretty straightforward, no other disposals and no losses. That's a simple sort of CGT point. And if we know the mechanics of CGT, we should be able to lay that out. And again, some very, very easy marks for laying out the payment date, given that it's between Jan and 30th of November. Okay. Now for Ronald, as I said, very often, whether or not it's purchase of own shares or other areas, perhaps residency and reliefs that are available, if you get two people, one will comply and one won't. And that's certainly the case here, because Ronald's only held the shares for 4 years, so he will not qualify for the favorable treatment. So what is the income tax treatment? Well, it's certainly more expensive, and that's for really one main reason, apart from the rates, is this area here. Now, you remember above that we said that the CGT treatment takes the cost of the shares, in other words, what the individual has paid for the shares. With the dividend treatment or the distribution treatment, we're looking to take the par value, okay, not the cost. So watch for that. And you'll see here that, a bit like the CGT treatment, it's sort of a mini IT comp. Okay, so draw your attention to the difference between whatever the individual receives less the par value. And then in effect, we get this sort of the Schedule F income for the individual. Then we're simply applying the 52%. Now, watch for this DWT, because, and bear in mind that the company may apply to the individual for that. In other words, ask the individual to pay for that. We've got in effect, a sort of a tax credit being applied in the income tax comp for the individual, which is good. Yeah, obviously that reduces their liability. So the balance shown is 3040. Okay, we just got the payment date there in line with the tax return filing date. So in terms of other areas here, just watch out for these small points. Not overly important, but we might get an extra mark here and there. We're not going to get a tax deduction in the CT comp for any of the payments that the company has made, i.e. the proceeds that they've paid out. Stamp duty will be payable, obviously, on the purchase at 1%, because that's a purchase of shares. And just a point here in relation to redemption, I don't think this is overly important. It's just a way of sidestepping the stamp duty if the shares were converted into redeemable shares. Now, in terms of other issues, I guess two main ones here in this area of purchase of own shares. The first one is that the company needs to have sufficient reserves, and the second one is just your standard sort of minutes of board resolutions in relation to these transactions. In other words, they have to be minuted and a board meeting and resolution must be passed. Okay, so that really is a very, very quick summary on this area, examined last year, in fact, by your examiners, John Morrison. So, do look at the structure of the answer, have a good read of that question, and hopefully that will be of help to you if this area does feature again. Many thanks.